Tuesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with David Faber, live at Post 9 of the New York Stock Exchange. Sarah Eisen's live in D.C. this hour. A huge interview you don't want to miss. ECB President Lagarde's with Sarah in just a moment. Meantime, get a quick check on the markets here. S&P's up about 77 points. Dow up 580. Watching Treasuries as well, still south of 4.4. About 30 minutes into the trading session, some earnings movers we're watching. Industrial names, GE Aerospace and 3M gaining. 3M warning the tariffs could drag on full-year earnings by as much as 40 cents, while GE maintained their guide, plans for cost cuts and possible price hikes ahead. A number of results out of the defense names, Lockheed Martin, Northrop Grumman, RTX, all on the move. Stocks with consumer exposure like Kimberly-Clark, Genuine Parts, reporting net sales and same-store sales declines respectively. And we got a fresh read on housing. Pulte, the latest name to warn of, quote, affordability challenges tied to high selling prices and monthly payments. That said, it was a top and a bottom line beat. Sarah, tell us about D.C. today.
Okay, so I'm here because it is the kickoff to the IMF World Bank meetings, and this is when all the finance ministers from around the world and all the central bank chiefs from around the world come to Washington, and usually they talk about, how to revive growth. This time around, there's a crisis on trade, and so there will be bilateral discussions. Some of these foreign ministers, finance ministers, are hoping to make trade deals or at least get discussions going with the White House. And others are talking about how to cushion their economies. So with that in mind, the backdrop here is the U.S. versus the rest of the world. And I just thought I'd show this chart, which I think encapsulates what's happening right now. This is the April chart of the S&P 500, our market in orange, versus the rest of the world. The U.S. is underperforming. And there's some interesting stats on this. Bespoke, for instance, took a look at the U.S. It's the second worst performing of 45 different country ETFs since President Trump's term began in January. It's down 14% versus the average country, which is up. It's underperforming Germany, for instance, something we'll talk about with ECB President Lagarde. So President Trump launches all the tariffs. The U.S. underperforms. I think David and Carl, part of the explanation here is that going into so-called Liberation Day, the U.S. had been outperforming. I mean, the U.S. exceptionalism trade was alive and well. U.S. equity markets, by so many measures, were extremely expensive. So some of that is just the unraveling of that. But it is something to talk about when it comes to who has economic leverage and how much pain the market is judging. The IMF, for its part today, out this morning with a new global growth forecast. No surprise, it slashes its global growth forecast from in the low 3% down to the 2s. And then here's what it says for the U.S. U.S. is only going to grow now 1.8% this year, which was a cut of about 1%. Importantly, though, not a recession. So we're going to talk about the IMF chief next hour about what goes into all that and how they're thinking about the damage here.
Sarah, you mentioned exceptionalism, and we've talked about the reversal in capital flows. I think it's obviously an important topic, and what happened to the dollar or what has been happening to the dollar, not to mention gold. David Solomon, who runs Goldman Sachs, was asked about it on Squawk Box this morning. I thought his answer was interesting in terms of, how long exceptionalism will last and what we're seeing in terms of the reversal of some of these flows. Let's take a listen and talk about it on the other side.
I don't think that we're taking 80 years of a direction of travel and just reversing it instantaneously, but I do think these are serious things that you have to watch very, very carefully. And if we don't get to a policy place of certainty where people can trust and they can rely, it will have longer-term implications.
Certainly interested, Sarah, to hear what Lagarde has to say about that as well.
Same here, David. And that generally jives with, I think, what I'm sure you hear from investors and what I hear, which is U.S. dollar reserve currency, not going anywhere. There aren't really any viable alternatives right now. But, with questions about credibility in U.S. assets, risk-free assets, the unwind of the U.S. exceptionalism trade, there's a lot at stake here. And I think the other sort of chart here that explains what's happening and what is so unusual, and people are texting me all day long, like, how do you achieve this? And that is stocks selling off, bonds selling off, the U.S. dollar selling off all at the same time. I think that triple whammy is what makes people in the market a little bit worried. Why? Because usually when the stock market sells off very sharply, there's a safe haven flight to bonds or to the dollar. They are traditionally safe haven, but there's been an unwind where both of those have been going down along with U.S. stocks. And that is an interesting correlation that started really post those tariffs, those reciprocal tariffs were announced. And that's something to watch when it comes to David and Carl talking about this theme about U.S. assets and whether there are some serious questions down the road.
Yeah, exactly how Solomon put it. Really quickly, Sarah, I did notice, speaking of Europe, that the EC President von der Leyen said the world is, quote, lining up to work with Europe amid the trade war, having meetings with the leaders from Iceland, New Zealand, Malaysia, the Philippines, Canada, India, UAE. That sounds like something our president would say.
It sounds like a threat, for sure, that Europe should go at it alone. But the point is, Europe and the U.S. are very important trading partners. So they want to make a deal. The U.S. wants to make a deal with Europe as well. But it is something I'm going to talk about with Lagarde, which is how many options does Europe have to go at it alone, if that really is the call from Europe. I mean, their strategy here has been interesting. They haven't announced new retaliatory tariffs since the reciprocal tariffs on those directly. They want to come and make a deal, and European leaders are talking about lowering trade barriers. We saw the Italian prime minister in Washington last week. But at the same time, they're talking about ramping up open trade with other countries. And certainly there's potential there. But when it comes to Europe and the U.S., the two biggest economic superpowers, when you combine the 27 nations in the EU, they need each other. We need to see a deal here. It's not realistic that they're going to go about it without the U.S.
We'll see, Sarah. Interesting. It's going to be a heck of a week. A lot of news flow. Sarah Eisen in D.C. this morning. We'll see with Lagarde in a moment. Want to bring in our senior markets commentator, Mike Santoli, thankfully back from a break here at Post 9 with more on what he's watching. And this notion that maybe 5,100 is a firmer floor than we thought a couple days ago.
Yeah, it obviously has a plausible basis of being a little bit of a floor. I mean, I don't think there's any magic to it. I do think what does happen is when you get a bit of a disorderly sell-off like there was yesterday, and frankly, you know, looking at it from a little bit of a distance, it didn't seem to me to be that logical that it would be strictly in response, I know you guys were talking about this, to the, the aggressive
stuff.
language about
Yeah.
Powell. It's like a lot of it was maybe China kind of hawkish tone and things like that. But more to the point, the big picture is the trends are lower, right? It may not be ultimately a durable bear market, but you have to almost operate on the premise that rallies are suspect and this market has to earn back the benefit of the doubt. How does it do that? Well, when you're at 5150, which is where we closed yesterday in the S&P 500, you're less than 4% to the lows of a couple of weeks ago. The absolute lows for this move, that's 4850. The upside to the top end of the range, which is just the low from April 2nd, is 8%. So you have twice the upside versus the downside if you're just trading the range. And I think that kind of thing, once you have very washed out positioning, I've been saying that for weeks, it's now even more the case. That institutional positioning has gotten very cautious. Defensive leadership is the only thing you find within the stock market. You look at the low volatility ETF relative to the market. It's been a place to hide. Everything else is nothing but gold. So all that together with the understanding that even though the trends might be lower, we stopped exactly short of a 20% decline on a closing basis. There's a long history, I talk about this all the time when it gets relevant, of 19% peak to trough declines in the S&P 500, way more than you would expect just by random chance, okay? That was 2011, that was 2018, it was 2015-16, I believe, it was 1990. You have all these instances where somewhere there's a bid at the down 20% level. Bundle all that together with the understanding there's upside risk if you get any kind of a trade deal. I think that explains today. It explains the chop. I don't think it settles anything. It doesn't settle the whole sell the U.S., buy gold type of trade, which maybe is starting to seem crowded and obvious. That doesn't mean it's over.
Right. I mean, I mentioned earlier, again, having nothing other than long conversations with people that I've been talking to for so many years. Negativity, man. Everybody is negative. Don't know what that means. You seem to be explaining it might mean we get a bit of a rally.
I think it does mean that, at least on a narrow time window. Yes, it usually does mean that. And that's why bear market rallies are so ferocious. You have a lot of pent-up short covering that can happen. And people who just are going to feel underinvested if the market seems like it found its footing. And, you know, so much of the downside yesterday was also, again, in the big NASDAQ 100 stocks. You know, Meta just getting thrown overboard.
Meta,
and all of these names. And it's like, well, that's not really finely geared to Fed policy. That's not really about, you know, something that's about interest rates. It's kind of just the world owns a lot of these stocks. They need to own less of them at the moment.
Mike, stay close. Good to have you back. Mike Santoli here at Post 9. Let's get back to Sarah in D.C.
Hi, Carl, again. And yes, joining me here in Washington at our bureau is the ECB President, Christine Lagarde. Great to have you here. Welcome.
Lovely to be with you, Sarah. Good morning.
It's nice to see you again. Nothing to talk about here at the IMF meetings. Trump's tariffs are clearly front and center. I'm curious how much it's changed your view on Europe's trajectory.
Well, it has an impact, and we were at a stage where all the previous shocks that we have taken, from pandemic to energy crisis to very high inflation, were really fading away, and the disinflationary path is clearly on its path as we had expected. And then a series of shocks hit our screen. Number one, the tariff. Number two, important as well, is the whole defense momentum that is taking up in Europe and which has led, in particular, Germany to increase significantly its commitment. And number three, and this is really a result of the tariff announcements and subsequent developments, structural reforms, which Europe had been talking about, which had been described in various reports, which Europe is now saying, okay, now it's time, and it's Europe's hour to actually do the things that have to be done. So it obviously has an impact, some of it positive, some of it negative. I think on the growth front,
sure,
we've always said that it would be a lose-lose, and we're seeing it.
I'm curious what your reaction was when you saw President Trump unveil those so-called reciprocal tariffs, and that 20% tariff was coming on all European goods into the United States. What were you thinking?
I try to look at things in a very positive way and focused on my mandate. That's what I have to do, and that's what a central banker has to do. So I look at that and I think, okay, where are the vulnerabilities? Who are the trading partners with which we deal most? And how do we address vulnerabilities if we have them? And how do we secure those trading relationships anyway? And when you look at it, Europe is difficult to understand. For most people, there's Germany, there is France, there is Italy. But then there is Europe. And Europe is the federation of 27 member states. And if you look at trade, 65% of our trade is intra-Europe. So our Europe's main trading partner is Europe. So that's number one, which means lower the internal barriers to make sure that trade really moves around both in goods and services. And services matter enormously. So that's, point number one. Point number two, we have to be attentive to the developments of the relationships between the US, the rest of the world, the US and Europe. And we have seen very successive movements, announcement and then a pause and then some exceptions. So we have to be very attentive. We have to be agile in the way in which we respond. And that agility means that we have to be ready to take action. Either we cut, either we pause, but we will be data dependent to the extreme.
Well, okay, I'll get to monetary policy in a moment, but just on the trade talks, so now you're at 10%, and there's some breathing room to get to some sort of trade deal. How do you see that?
I'm not sure we're 10%, by the way, Sarah, because we still have, higher rates on aluminium and steel and the car industry.
Okay.
So
I was talking about the blanket.
Yeah.
But yes,
but if you look at the real tariffs in the relationship between Europe and the US, we were at around 3%, and we moved up to 13% more. We were a little less than 3% actually on goods. So it does increase the tariffs, yes.
So how do you see it playing out, these trade talks? Is there scope for a negotiation, for a deal?
I am sure that there is scope for negotiations. I mean, it's in the nature of policymakers to want to sit down and argue their case and point out their imperatives, their red lines, their vulnerabilities, and I'm sure that there can be a dialogue. I would be surprised if there was not such a thing. It will be a process, let's face it. But I think that there will be negotiations, yes.
You said that the intra-Europe trade is most important for Europe.
Yep.
What about the U.S., European trade? How exposed is Europe, really, economically?
Well, as I said to you, it's of the non-intra-Euro area trade, okay? So 65% is Euro area and European Union. But of that non-Euro area trade, the US is 17%, okay? So it's not a gigantic movement of goods and services. By the way, really it's important to remember that we ship back and forth goods. We ship back and forth services. And if the US if we have a surplus in goods, the US has a surplus in services.
Right.
So it's not a complete wash but it's a lot less than the numbers that I've seen floating around.
That's one of the fears, actually, is that Europe can punish the U.S. on the services front, taxing digital ad revenues, for instance, in Europe. Is that something that you think is realistic?
You know, there will be a negotiation process. And as part of the negotiations, people show their strength, keep their cards close to their chest, they drop them as and when suited. I'm not privy to that. And I'm sure that there will be a will to negotiate. That I'm certain of.
The president has repeatedly said that Europe has been ripping off U.S. automakers, for instance. I mean, has Europe been unfair to American industry?
I really don't think so. There is so much, there is so much joint interest between those two economic continent, if I can call it that way, because Europe is a vast economic region, 450 million consumers, very advanced economies altogether. And there is a lot of foreign direct investment between the two countries. There is a lot of trade going on, goods and services. So there might be sectors where serious negotiations need to be had. But it's going to be, as always with trade. I was trade secretary for 2 years of my public life. It's unbelievably complicated because you have thousands of, I think it's more than 8,000 lines of custom duties for all those products. And of course it's going to require a tedious, serious work to get down to what is acceptable to parties and where the vulnerability points are addressed. And it's not just on one side, it's on both sides.
You're also head of the IMF. I feel like you do not like tariffs. Is that true?
I'm a free trader by sort of nature and practicalities, because free trade has always enhanced the overall growth, has been a serious contributor to the development of the economies, all economies. Then how it is distributed, how the benefits of trade are distributed in any given country is something for that country to decide. But I think that if you look at the aggregate, yes, trade has always been beneficial.
It's interesting, as a result of all of this, the euro has gotten stronger and European markets like Germany have outperformed U.S. counterparts. Why do you think that is?
You're correct in that it's a bit counterintuitive. Initially, and when we had done our projections, we anticipated that the dollar would strengthen and that the euro the euro would appreciate the dollar would appreciate, the euro would depreciate. It's not what we saw. And there have been some counterintuitive movements in various categories. Currency is certainly one. The German market has obviously been shocked in a positive way by the program of the soon-to-be put in place German government, with a commitment to defense, with a commitment to a big fund for infrastructure development, with the debt brake being put aside when it comes to investment in defense. This is a major push in the direction of let us spend the money that we save here. And there's a lot of saving in Europe to make sure that the infrastructure works better, to make sure that our defense, which is a vulnerability, is improved. So that's hardly surprising. On the euro, and it really reflects on the fundamentals of Europe, on what the confidence level is with respect to Europe. Europe is, I think, associated with freedom, free trade, we just talked about it, stability of prices. I think we are working as hard as we can to deliver that price stability. And credibility. Sometimes we are criticized because we are overruled. Oh, too much regulation in Europe. Well, sometimes to stick to those rules and to apply the rules gives a level of certainty, sometimes cumbersome, which is why simplification is very much in the cards, but it reflects.
Do you think there's a credibility question with U.S. assets right now?
We have to look at, where the markets are going, and I don't think that I could pass a judgment on that. It's a matter of how investors behave.
So euro strengthening, is it getting too strong? And if it continues to strengthen, what sort of options would you look at? Would you consider intervention?
I don't comment on exchange rate, and obviously we monitor, and obviously we take that into account for purposes of identifying inflation and the risk that we have.
Well, it should help with your fight on inflation. I mean, you sound pretty confident
Sure.
that you're going back to 2%.
Yeah, by the defense investments, by the infrastructure fund that we talked about, and the impact of the structural reforms. But I think it's an interesting composition and a fascinating moment to observe how it's going to impact and hopefully be executed.
I guess my question on policy then is downside risk on inflation, at the same time downside risk on growth and a potential growth
I would put
shock.
it the other way around. I think downside risk on growth,
Yeah.
which I think is pretty much a given, and not just in Europe, by the way. The net impact on inflation, I think we need to continue checking the data, because whether you look at the very short term, whether you take into account the countermeasures, whether you anticipate some increased trade of Chinese goods into Europe, all that will have an impact. So I can't say, definitely downside risk materialization on inflation. We have downside risk in the short term, but the net impact to be
TBD.
To be seen.
I get, because my question was going to be, why aren't you cutting maybe faster or even larger, given a more benign inflation backdrop and bigger risk to growth at this point?
As I said, the net impact on inflation is to be seen. There is too much variables coming into play for that purpose. And as I said, we have the options on the table. We will be data-minded, data-dependent. And in terms of options, we may well cut. We may well pause. It's really going to be meeting by meeting, data dependency. We have, the criteria of our monetary policy stance well established. It has served us well so far. We will stick to that and will be as predictable as is possible with the data that are coming in.
You've gotten props from President Trump last week and then again this week for cutting 7 times at a time where he would like to see the Federal Reserve cut interest rates. What was your reaction to that post?
Monetary policy decisions are driven by the economic circumstances that we face. And I think that all central bankers around the world are loyal to their mandate and observing the facts and analyzing the data as well as they can. This is what we've done in Europe. We have inflation coming down seriously. As I said, last reading 2.2%. Our projection for 25 is likely to be 2.1%. Inflation expectations are very anchored around the 2%, including in the medium term, and we have growth which is projected to be 0.98%, depending on whose projections you're looking at. The U.S. is a different situation, and the impact of tariffs will be different on the two economies.
What is your expectation there? Higher inflation in the U.S.?
I think the IMF came out with some projections this morning, and they did increase the inflation projection for the United States. But it's inevitable. If you raise tariffs on goods coming in, this is increasing prices, added to which it creates uncertainty. So the combination of the two is bound to wake up a little bit.
I know you're close with Chair Powell. I mean, I know you communicate pretty often. Have you talked to him about some of this new political pressure?
We're both used to political pressure in one way or the other. But as I said, I have immense respect for the work that he does and for his loyalty to his job and to being as diligent, disciplined as possible to deliver on his mandate. For him, I think, I'm sure, as it's for me, the mandate is our compass. We have to deliver on our mandate.
If there is an attempt by the executive branch in this country to fire Chair Powell before the end of his term, do you see that as a material risk to markets?
I very much hope not.
Hope that doesn't happen.
Hope that it is not a risk.
What would it mean for the markets?
Look, I'm not going to comment on, market reaction to hypotheticals that I hope are just not on the table.
Understood. But speaking of some of the reaction here, I'm wondering how you're feeling about the European banking system, if there's been any spillover, considering some of the financial stress we've seen as a result of these announcements.
We haven't seen spillovers. And what I can say is that under the regulations that we have, which is Basel III, with reference to a Swiss town in which we meet on a regular basis, but which has brought all the regulators and sometimes the supervisors as well together to make sure that we don't have a cataclysmic disaster like we did in 2008. I was there. I don't want to see that again. So our banking system is, I think, solid. The banks are far more better capitalized than they were before. And I think the probably more scrutiny applied to supervision than was the case at the time has served us well. And we should really abide by those principles. Not always pleasant, not always, stress testing and scrutiny is always resented because you want to run your business. But to the extent that it is conducive and critical for financial stability, we need to do that.
I think you mentioned increased trade with China in one of your answers as a potential impact on Eurozone economy. I'm curious what your expectations are there. I mean, a potential trade deal with China, is that something you could envision?
That is something that the European authorities in trade, that is the Commission, will have to decide and will have to conduct. But it's an economic natural consequences or second round effect, if you will, of very strict and very high tariffs imposed by the lead partner of China. China will face a moment where it has overcapacity and it has to ask itself, what do I do with that overcapacity? Where do I sell my goods?
And you think Europe is a destination?
It's one option for them, for sure, but it's not for me to speculate what they're going to do with that. And I hope that a trade deal will be something that can be considered by both partners, the United States and China.
I mean, there's an effective trade embargo between them now, 145% tariffs, 125% tariffs the other way. How disruptive is that for Europe and for the rest of the globe? Just those
I think
two.
It's too soon to say. It's too soon to say. But they're hopefully, as I said, there will be a trade deal between these two economic giants, and that will be, acceptable or not too unacceptable for both partners as deals are. But as far as we're concerned, we're going to focus on our business and make sure that our economy is competitive, that our regulatory environment is rock solid but simplified, that we have a stronger and wider capital market union, and that we address all our vulnerabilities as they have arose as a result of the shocks.
I mean, it's such a change. When we spoke in Davos at the beginning of this year on a panel, the concern around Europe was Europe is uncompetitive. Europe has too many regulations compared to the U.S., which is exceptional now, with deregulation, pro-growth policy. It feels like the tables have really turned, but long term, I do wonder if those questions are still going to plague Europe.
We shall see, and time will tell us whether this sort of whether the Europe's hour that I very much see at the moment will turn into a new Europe that is more competitive, less regulated, more efficient, keeps some of its savings at home to invest in what is necessary.
Is that realistic?
Defense, energy.
So many governments.
It's hard. It's hard. But look, whenever we had major crisis, whether it was in 2008 with the great financial crisis, whether it was with COVID, the Europeans, rolled up their sleeves, pulled up their socks, and delivered something that was totally unexpected. The Next Generation EU 1 trillion investment, which is being spent at the moment on a joint basis with joint borrowing, we would never have dreamed of this. Well, I think that this is another time when Europe can just grow up and be stronger.
But we are in a technological revolution at the same time, and Europe doesn't have a ChatGPT or Google or an Apple or a Meta. Why is that?
I think it has to do with the fact that there was not so much focus on productivity. So that's number one. Number two, the ecosystem that is so vibrant in this country, in the United States, which combines equity funds, capital venture funds, the innovation around universities, which have played a critical role in those inventions. All that combined created those ecosystems that gave birth to these giants. I think those are conditions that can certainly be recreated, and if Europe is as attractive as it is with freedom, with stability, with credibility, and the determination to execute on the plans, I'm sure we can do well.
What about...
There are other areas, by the way, where Europe is a champion, but I don't want to brag about Europe. I just want to make sure that...
Well, it's your job.
We do.
You have been a champion of Europe's steadfast champion, which is why you're in the job, I think, in part. But what about a potential end to the war in Ukraine? I mean, now that there's this U.S. diplomatic push, what would that mean for Europe's economy?
I think what it means first is peace for people who've been at war, and in particular peace for the Ukrainian who've demonstrated their aspiration to freedom and their determination to fight for their territory and to defend their country. That's what it means first and foremost. Then, provided that happens, and I very much wish that peace will be about, then it will be reconstruction. And it will mean, supporting, helping, dealing with the needs that Ukraine has, and processing the application for European Union membership, which is something that has been decided.
What is your chief mission here in Washington this week? I mean, I feel like the bilateral meetings take on a new
importance. To meet you, that was my
first
mission.
That, of course, thank you for the time on that. But seriously, as far as talking with U.S. counterparts, how do you think this whole trade situation changes everything?
I think we will go through a period of at least, I don't know how many are left, but probably, 75 further days of trade talking, negotiating, behind curtains negotiations, and I'm sure that there will be plenty of that during this week, but not only during this week. And that is unsettling, because it's a period of uncertainty that nobody likes. You don't want to invest, you don't want to employ, you don't know where you're going to go. In terms of economic development. So that is taking place, and I think that at the end of that period, we need to have a system which at least is predictable, is reliable, and those are really very strong wishes that I have, and that things will not change every other week after that.
Is that why you don't have recession forecast, because you think that'll happen?
We had a recovery that was sort of taking roots, and hopefully, given the fact that we have this large economic zone, that we trade amongst ourselves a lot, that we're going to expand the trade relationship that we have. Europe is the first trading partner with 72 countries around the world. This is no small potato, and we're going to activate those trade links as much as we can. So we don't see a recession. No, we don't.
In Europe or the globe?
I'm talking about the euro area for the moment.
Well, Christine Lagarde, thank you so much for coming here first in Washington and spending so much time talking through all these events. Appreciate it.
Great pleasure.
Always a pleasure. Christine Lagarde, the head of the ECB. And guys, we're not done here in Washington. We've got another big interview next hour. The IMF Managing Director, host here, Kristalina Georgieva, will be joining us on their new economic outlook and much more in the next hour. Back over to you guys.
Great stuff, Sarah. David and I listening intently here. I guess, questions will revolve, David, around what any kind of trade deal looks like, whether it's just a sort of a memorandum of understanding. And then when you're dealing with a president who clearly likes to throw tariffs at anything that irritates him, how much trust is there in the durability of any agreement? Yeah,
all great questions. I think, Sarah, as well, that very hard to get some concrete answers to at this point, certainly, whether or not we're going to see some sort of, again, to Carl's point, agreement in principle yet to be fully negotiated, but even that perhaps would rally the markets and settle some nerves.
Yeah, I think need to see some trade deals for sure, and the administration clearly is working at that. And the only other thing I would mention just on what could be productive here is that the White House is listening. They hosted the heads of Target and Walmart and Home Depot at the White House yesterday, and the official line on that meeting was productive. What I can tell you, according to people familiar in there, is that the White House was listening to, especially what these high tariff rates are going to mean from China on the U.S. for American families who buy strollers, who buy baby products. I mean, that's made in China, and it will raise their prices. I'm told that they didn't necessarily discuss any off-ramp or options there, but they were heard. as far as the painful inflationary effect on Americans. And that's potentially something productive and useful as these trade negotiations get underway. Will there be exemptions? Will there be relief? Will there be some sort of off-ramp? All of which I think the market and central bankers like Christine Lagarde would be happy to see.
Yeah, we're watching to see whether or not supply chains break. The back to schools coming in, are supposed to be coming in right about now. So we'll see what the summer brings. Sarah, thanks. Sarah Eisen, of course, in D.C. Still ahead, why Barclays says tech is worth taking a look at here. All the Mag 7 names on pace for losses in April. As for the broader markets, trying to get some back today. Dow's up almost 700 points, and we're almost back to 52.50. Back in a moment.
Scott Wapner from the NYSE. Closing Bell, CNBC.
My desire to keep learning, that is what drives my ambition. I sought a career change after 5 years working in corporate law to pursue a passion, which is to tell people stories and help our audiences make sense of the world that we live in.
Wake up to Squawk Box Asia as we set the agenda for Asia's Business Day. I'm Martin Sung in Singapore.
And I'm Sherry Kang in Hong Kong, bringing you breaking news, in-depth analysis, and the stories behind the numbers.
Stay ahead with the insights that you need to succeed.
This is where business leaders and visionaries come together to shape the future.
Now live from Singapore
and Hong Kong.
Weekday mornings, CNBC.
One way or the other, but as I said, I have immense respect for the work that he does and for his loyalty to his job and to being as diligent, disciplined as possible to deliver on his mandate. For him, I think, I'm sure, as it's for me, the mandate is our compass. We have to deliver on our mandate.
If there is an attempt by the executive branch in this country to fire Chair Powell before the end of his term, do you see that as a material risk to markets?
I very much hope not.
Hope that doesn't happen.
Hope that it is not a risk.
What would it mean for the markets?
Look, I'm not going to comment on, market reaction to hypotheticals that I hope are just not on the table.
ECB President Lagarde a few moments ago with Sarah Eisen in Washington, D.C., talking about this renewed pressure on the Fed chair. Let's talk about the market implications and this rebound that we're seeing, at least today, with Venu Krishna. He joins us here at Post 9, Barclays head of U.S. equity-linked strategies. Venu, welcome back. It's good to have you. You got thoughts on to what degree the Fed pressure is adding to negative sentiment or price action?
It certainly is, but there's so many things happening simultaneously. I think it's incremental, but the overriding concern still is the magnitude of uncertainty and the inability of investors to get some sense of when they can expect the level of uncertainty to decline. That's a question we're handling a lot, for example, and that is intimately linked to the tariff policy right now.
Right. Now, you came into this era pretty cautious, but you are now saying even areas like tech have overshot at least a typical bear market, right?
That's right. That's right. It's very interesting because the scale of de-rating we have seen in big tech especially, it's well over 25% already. That tells you that a lot of the risk on earnings and tariffs have been priced. And interestingly, if you look at big tech, especially because it's a most important component of tech, the earnings revisions are relatively modest compared to the rest of S&P, where earnings estimates are coming down faster compared to a typical year, but nowhere close to what you see in a recession. So what I would argue is that right now, for the quality of earnings you get in big tech, it's coming to levels where you have to take a look. You cannot time it perfectly, but when you start approaching 23, 22 times forward earnings for the group as general, I think it's worth looking at.
That said, speaking of timing, I mean, none of them reported earnings yet. We've got a little bit. Tesla will get after the bell tonight in terms of at least considering it big tech. I mean, do you have any expectations when it comes to earnings season overall, particularly for this group?
Yeah, so we don't include Tesla in our big tech, just to be clear. But for the rest of them, the consensus numbers are closer to 16%. So at the beginning of the year, we were expecting it to be 21%, so which is still a lot less than the scale at which they've been beating their numbers for the last 6 to 8 quarters. So I would suggest that even if you get 16%, I think that's very healthy compared to the rest of the market. So remember, when we cut our earnings number for S&P about a week before Liberation Day, we took down our growth estimate from around 12.5% to 6%. But our downside case of a bear market, which increasingly is seeing a higher probability than even just 3 weeks ago, we have earnings going down 2.5%. I think if you look at the real impact of tariffs and the second order impact on growth and inflation, that number can even go down to about 4.5–5%. So you were talking about 20 percentage point swings in what can happen. So in that context, when you look at this group, where the numbers have not moved a lot, for the rest of S&P, like I said, numbers have come down faster than what you would see in a typical year, but nowhere like what you would see in a recession.
Are there then lingering or second order liabilities from, I don't know, advertising or, consumer that might affect names like Meta or Amazon at least?
I won't go into single names, but I would certainly say, just remind you that the two central pillars of U.S. economic strength over the last 2 or 3 years have been, one, the consumer, and second, tech. And both on the margin have weakened at this point in time, right? And the consumer is the most critical element to the U.S. story, right? We are such a consumption-driven economy. If you see, for example, hypothetically, a 2% increase in savings rate, which has been very, very low right now compared to pre-COVID periods, and you see, let's say, a 2% cutback in consumption, that can have a massive impact, including on advertising revenue eventually, which will affect tech as well.
Right. Yeah, we'll have to wait for more hard data, certainly, to come in the coming weeks. Venu, thanks as always. Good to see you. Thanks for coming in. Venu Krishna.
Well, speaking of Tesla, those shares have now been cut in half, at least from the 52-week high, and down about 41% over the course of this year. What can we expect, of course, when the company reports after the bell tonight? That'll be the subject after the break.
CNBC. Live ambitiously.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
Home to the world's biggest population and a fast-growing economy. Is the EV story resonating amongst Indian consumers? CNBC goes inside India to give you insights into the opportunities and challenges shaping the emerging powerhouse.
Narendra Modi seeks a historic third term.
Several indicators they cannot afford to look the other way.
It's all part of the normal flow of market forces.
The stories, people and businesses behind its rise. This is your gateway to India.
Inside the world's most cutting-edge technologies.
We're seeing a real opportunity for those with brilliant ideas to accelerate towards change.
Discover the secrets and turn innovative ideas into profitable ventures.
Our vision is a world where human prosperity and economic growth are planet positive.
Embrace digital disruption.
I mean, this is life-changing technology.
CNBC Tech, The Edge, only on CNBC.
As you see, having a nice move today. This, of course, ahead of the first quarter results. And as our viewers well know, though, the stock has been a laggard during the course of the year, down over 40+%. Streets pointing to weak deliveries and fundamentals. Of course, Elon Musk's political activity and subsequent brand damage for the company has certainly been a focus as well. Joining us now, TPG Capital Senior Advisor and former Ford CEO Mark Fields. Mark also served as interim CEO of Hertz, and we're happily call him a CNBC contributor. Mark, I'm curious what you're going to be listening for on the conference call and looking at when you get the earnings today from Tesla.
Well, it's going to be, as always, an interesting earnings call. I think the things I'm going to be looking for is, first off, what are they going to say about sales volumes and demand going forward? I'd like to see an update on the autonomous driving and the robotaxi service and the economics around that and the timing. Of course, want to hear commentary around the tariffs and the impact that can have, at least in a range, on the business. Going to want to hear about this entry-level model, which we've seen in the news lately. It's either in or out or decontented models. I also think, that what's going to be a lot on people's minds is how much longer is Musk going to devote his time to the government and get his focus back on Tesla. And then finally, David, I think the other thing I'll be looking at is the automotive gross margin net of the regulatory credits that they sell, because that's an important metric. And if you think about those regulatory credits, last year, their net income, they represented about 30% of their profits. And as these legacy automakers sell more and more EVs, that opportunity for Tesla is going to dwindle over time. So I think those are the things that at least I'll be looking at.
That's a great sort of playbook, I think, for a lot of investors. Listen, typically they spend a lot of time talking about not the automotive business, but Optimus or full self-driving, robo-taxis. I would expect no exception this time. I'm very curious, as I think you are, to hear what the impact may be from tariffs, because I've been hearing, despite the fact that they're seen as a domestic, or they are a domestic manufacturer, they still are relying on a lot of foreign parts. Do you have any estimates, in terms of what you kind of think, Mark, what an impact might be in terms of tariffs? Not just...
but they still get a good portion. And that's going to depend on the tariff amount. Is it going to be based on the 25%? Is it going to be based on something less? I think the bottom line is at its highest level, listen, it's a net negative on profitability. And in Tesla's case, I think the irony, David, is, the stock is currently is priced as a growth stock, but it currently has no growth. And so I think people are looking at commentary on autonomy, commentary on tariffs, commentary on Optimus, so that they can maintain that confidence, if you will, to keep that stock price up.
Think we'll get any commentaries on used car prices? Because they have been falling dramatically, I believe, at least according to some metrics for Teslas. I don't know how that figures into the overall value proposition, but I'm curious to get your thoughts.
Well, they may comment on it. Listen, it's important for Tesla customers, right? Because when they buy a vehicle, they want to make sure 2-3 years down the road, when it comes time to sell it, that they're not underwater if they're taking out, financing on the vehicle, so to speak. But what we have seen in the used car market is we've seen residuals actually come up over the last month because the calculus there is, listen, as tariffs are put into vehicle prices on new car sales, that's pushing up demand for used cars. And I think you're starting to see that a bit with Teslas. But, over the last year, residual values has really taken a hit based on both the pullback in consumer interest in EVs, but also for the price discounting and price cuts that Tesla has implemented.
Yeah, now we're checking the Car Guru's index every day, and you're right, Tesla is an outlier. I did want to ask you, Mark, every now and then we get a hot take on autonomy. Yesterday it was the B of A desk, and they write, autonomous driving is a solution looking for a problem, and grim unit economics is not a great backdrop for aggressive product or market expansion or blitzscaling. I wonder, is that a rare view still at this point?
Well, it's probably a rare view, but there's some truth to it, Carl. I mean, if you think about autonomous vehicles, and the use cases, it's really in dense urban areas. So let's use the U.S. as an example. There are so many kind of dense cities in the U.S. where this could be applicable. Outside of that, probably the use case is not very compelling. Secondly, when you look at the business case, whether it's Waymo or Tesla or anybody else, they haven't come out with what's the business case to, turn this into a profitable business over time. Because the capital expenditures that you have to make into the vehicle itself and then all the computers and sensors that you need to put on it is quite expensive. So that really has to come down combined with good revenue growth. And there's questions around how big the market for autonomous actually is outside of, major urban areas.
Yeah. Finally, Mark, we kind of skirted this a bit, and you mentioned it, but very hard to quantify the brand damage, if any, that Musk has done as a result, of course, of his association or leading the Doge effort, and obviously his willingness to be outspoken on so many different issues, seemingly perhaps ostracizing the very client base that he once focused on in terms of buyers for his vehicles. You have any thoughts on that?
Well, listen, I give Musk a lot of credit for doing a thankless job in what he's doing with Doge and the government. But, ultimately, you're basically alienating your main purchasing base while appealing to a base that maybe not is particularly interested in your product, and that's not a great business strategy. But yes, there's a brand impact. But let me give you an example, David. So during the Great Recession, when GM and Chrysler went bankrupt, there were a lot of pundits and experts that said, oh, this is going to damage their brand forever. And guess what? After 2 or 3 years, people forgot, and it's not even on the radar screen. I think in Musk's case, there's obviously a near-term impact. But I think once he gets back focused on the business, and as long as they're bringing out great innovative products, good services, and continually push the innovation button on that brand, that'll heal itself over time, but it does require him to get, focused back on this business.
Yeah, well, all the more reason why we're going to be focused on that call and see what we get from Musk. Mark, always a pleasure. Thank you.
Thanks.
Mark Fields. Before we head to a quick break, take a look at shares of Netflix. Of course, the company reported earnings after the bell on Thursday. No trading Friday, but we did see a response yesterday to what was a very strong earnings report, although, of course, not sharing any more details on subscriber additions and targets the way they have in the past. That's gone. That is not dissuading investors from piling in. 7.5% is the gain. It is now up, as you see, some 91% over the last year. And Carl, as I pointed out, its market value now approaching 3 times that of Disney, despite the fact that its revenues they're not quite, but they're a little more than a third of Disney.
Yeah, it's added $100 in 2 weeks.
Yeah.
In this market. Not too many names like that.
No, it continues to distinguish itself as being sort of alone, so to speak. We've talked about kind of the winner of the streaming wars. It seems to also be the winner in the stock market as well. Speaking of the stock market, we do have a nice rally underway that continues. Even some laggards that we saw earlier, such as Verizon, are up now as well after that company reported earnings that were not particularly well received. The S&P nearing a 2% gain and the NASDAQ at over 2%. Kristalina Georgieva is the next guest on Money Movers with Sarah down there in D.C. Our live market coverage continues after this.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
Ambition to me is the American dream. It's why my mother came over from Taiwan. It's why people watch CNBC, because they want a better future. I was working as an analyst in Shanghai when my company landed in the news on accusations of espionage. I decided right there and then that I wanted to be on the other side reporting on the news. I love bringing transparency to complicated topics. I think it's so important for us to deliver the right numbers to our audience so they can make better investment decisions. San Francisco was built on ambition, a belief that anyone can disrupt any industry and change the world.
A CNBC original exploring equality.
My quote since the beginning was, don't change yourself, change the game.
If you want to be more innovative, more creative, come up with alternative ideas to solving problems, you've got to be more diverse.
And LGBTQ rights and our acceptance are on the line all over the world.
We have something to bring to the table for the solution that we can find together in this fragmented world, and music is always at the center of it.
Real lives, real stories, only on CNBC.
The day's top stories driving Wall Street. Brian Sullivan joins Kelly Evans. Power Lunch, CNBC. CNBC. Live ambitiously.
So we have been here for the last 90 years, and because of that, it's so important. We have a long-term brand building goal and journey. Short-term marketing effort, short-term KPI is critical. Because these are the building blocks. By validating a lot of the activities, through engaging our customers, through discussing with them their needs, understanding what we want to do, eventually we add them together. That is our long-term brand strategy. Banking is a people business, and that's why we need to enable and trust our team, our teammates to work, so that they know very clear strategic direction from the head office, from the seniors, and we lead by example.
There's a difference between ambition and greed. Greed is wanting more. Ambition is wanting better, and not just better for yourself, for your family, for your community, for your country. There's no reason to want CNBC if you're not ambitious, right? If you don't want better insights, better returns. And that's not just financial, though money is a part of it. We're talking about value.
The top fintech companies list is back. CNBC and Statista are looking for the world's standout firms, following in the footsteps of some of the biggest industry players. To find out more and submit your application, head over to cnbc.com.
What inventions have transformed humanity?
The wheel, the light bulb, the internet, and me.
Learn how to use AI to be more successful with CNBC Make It's new online course.
It's about how we embrace the technology.
What we're really talking about is automation of tasks.
You're going to feel like they were just always part of your life.
We'll give you examples and how you can use AI tools at work and in life.
Register at cnbcmakeit.com/AI.
The age of AI is now.
My mentor always told me that your career is going to be a marathon, not a race. Often, you're not the only one running, so learn from those in front, support those behind, and when it counts, win well and lose well.
Wake up to Squawk Box Asia as we set the agenda for Asia's Business Day. I'm Martin Sung in Singapore.
And I'm Sherry Kang in Hong Kong, bringing you breaking news, in-depth analysis, and the stories behind the numbers.
Stay ahead with the insights that you need to succeed.
This is where business leaders and visionaries come together to shape the future.
Now live from Singapore
and Hong Kong.
Weekday mornings, CNBC.
Scott Wapner from the NYSE. Closing bell, CNBC.
The climate crisis is a gun to our head, so we better get our act together.
We need those at the forefront of creating a sustainable future.
Our work has been accelerating, and we've now hit 43.7 million people rather than kind of traditional charity. It's more about empowerment.
Climate change is like the internet. It gets bigger every year, it never goes away, and you have to learn to make money from it.
In the last 10 years, we've seen a very encouraging sign of much more products coming online into the market in terms of green and sustainable products.
An issue that affects every generation.
These kids, it's great they're fighting for their right to have a planet to live on. You've got to scream to be heard. You don't just sit politely and go, oh, I can have a conversation about pollution, please.
Soil is not our property. It's a legacy that's come to us from previous generations. It's very important we pass on living soil for future generations.
There is hope for the future, but only if we take action and take action now.
Join the sustainable future only on CNBC.
CNBC is on assignment in Barcelona as Spain once again plays host to the Mobile World Congress.
We have all this kind of wildfires everywhere. You know, there is the need for data centers, there is the need for more computation power, there is this need for AI, there is the need for connecting the world to bring businesses together, there is the need for consumers to have faster access. And for all of this, you know, we are kind of firefighters trying to solve that problem, but we have a leaking hose here in Europe, because the regulatory environment is not fitting.
I think it has created a different thinking. The momentum's still there. Large language model continue to be prevalent.
AI is such a compelling technology. Every country in the world is going to pursue it. I think it's an imperative that the Western world lead in innovating in this new technology. That means investing in compute so we have the best infrastructure. It means investing in data so that the models can be trained in innovative ways.
Live ambitiously. Live from the New York Stock Exchange, Halftime Report, CNBC.
One partnership is bringing technology and modern farming together to advance agriculture and feed a nation.
We are starting with an automation platform. So a system which is controlling relevant machines, processes.
This is our prototype for the precision nutrient injector that interfaces with the Siemens platform that we're building. We're able to store over 100 different types of recipes. And on demand, the machine will actually mix it up and then deliver it to any Go bids.
It is in the same moment giving remotely access to artisan green at any point of time. They can see what is the status, what is their energy consumption, what is their water consumption.
The Energy Manager module from Siemens allows us to monitor the equipment, and with that we're able to make sure that the equipment's running at its 100% efficacy, and as a result, electricity costs that way.
Sponsored by...
Ambition for me means following your dreams and working really hard to achieve them. When I was growing up, I used to dream about studying abroad, speaking different languages. These early aspirations have shaped my whole life.
I'm gonna show you the way Vietnamese people enjoy coffee in the morning. I live here and I have to say that I love the traffic here, which seems like chaos to foreigners, but it's actually an organized chaos. Everything works. Xin chào! Hello, my name is Khánh Vi. I'm a content creator and a TV host from Vietnam. Here we are at District 1, which is the central of Ho Chi Minh City. I think this is one of my favorite spots in the Independence Palace. This is the way of selfie for Gen Zs. 0.5. I'm originally from the north central province of Nghệ An, but I've stayed in Ho Chi Minh City for a couple of years now. Ho Chi Minh City has such great energy, and you can feel that when you come here. Nguyen Huệ Boulevard, and I'm so excited to bring you around our largest city in Vietnam. And here's what I do in my downtime.
Berlin is a phoenix from the ashes. Yeah, we are the new kid on the block. 35 years ago, the wall came down and we had to start from scratch. We found out, who are we? The answer by our international visitors is, you are the city of freedom. Berlin is adrenaline, and at the same time, it's chill out. If your feet are tired and if your mind is tired of so many museums, impressions, then you can make a turn and you are in Tiergarten. Yeah, it's bigger than Central Park. One of the big trends we see coming is coolcation. If you look at the Mediterranean, many of the destinations become too hot in summertime. And we say, hey, come to Berlin because we have cool forests, cool lakes, cool museums, whatever you need. And a very cool nightlife as well, as everybody knows.
Next on Unlocked, dramatic renovations.
I'm not sure we would have done the renovation in the beginning if we'd have known what it was going to take.
Three friends bought an abandoned high school and transformed it into this apartment building. Couple turns an absolute wreck into their dream home, then say goodbye to electric bills. A 117-year-old house gets a total recharge. Now it unlocks more energy than it consumes.
Getting rid of gas and moving to a completely electric building.
Next on Unlocked.
What inventions have transformed humanity?
The wheel, the light bulb, the internet, and me.
Learn how to use AI to be more successful with CNBC Make It's new online course.
It's about how we embrace the technology.
What we're really talking about is automation of tasks.
You're going to feel like they were just always part of your life. We'll give you examples and how you can use AI tools at work and in life.
Register at cnbcmakeit.com/AI.
The age of AI is now.
CNBC has the most affluent audience in television, and my job is to tell viewers how the wealthy make it, spend it, and give it away. I grew up in upstate New York. Both my parents were artists, so we didn't have money, but they taught me to appreciate beauty and also see things a little bit differently. For a lot of people, their ambition is to get wealthy, but money itself doesn't have any meaning. It's how you make it and what you do with it that gives it purpose.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
Real money, real debate, real-time moves. Scott Wapner, live from the New York Stock Exchange. Halftime report, CNBC.
CNBC is on assignment in Barcelona as Spain once again plays host to the Mobile World Congress.
We have all this kind of wildfires everywhere. You know, there is a need for data centers. There is the need for more computation power. There is this need for AI. There is the need for connecting the world to bring businesses together. There is the need for consumers to have faster access. And for all of this, you know, we are kind of firefighters trying to solve that problem, but we have a leaking hose here in Europe, because the regulatory environment is not fitting.
I think it has created a different thinking. The momentum's still there. Large language model continue to be prevalent.
AI is such a compelling technology. Every country in the world is going to pursue it. I think it's an imperative that the Western world lead in innovating in this new technology. That means investing in compute so we have the best infrastructure. It means investing in data so that the models can be trained in innovative ways.
Thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, the rebound for stocks. The Dow, though, still pacing for its worst April since 32. We'll discuss and debate the road ahead for this market with the investment committee. Joining me for the hour today, Josh Brown, Stephanie Link, Rob Seach, and Jim Lebenthal. I'll show you the markets here. We do have a very nice bounce, and you do have the dollar up. You have yields down. So the backdrop feels better today. Not a lot of news other than that, and I guess that's the kind of market that we're in right now, where those items, bonds and the dollar, having as much to do with the market direction as anything. Rob, I guess I go to you first. What stems the selling in this market? What gets us out of this current environment? JP Morgan's trading desk today says, we feel a completed trade deal is the only catalyst that can break the market out to the upside, and we'd still need resilient macro data and solid earnings. And we really aren't able to check any of those boxes at the moment.
Not at the moment, but I do think that clarity is ultimately going to come. It's just a question of when. And right now we reside in that space in between where we're all kind of waiting for Godot to figure out what's going to happen. On the one end, you also have kind of a cap, not only a technical cap at 5,500, but a valuation cap, right? There is not a lot of room from a valuation standpoint. Earnings and GDP growth are still expected to be higher than maybe many of us think they will be. And so any positive news is going to be met with some resistance. On the lower side of things, we do know that we're going to get through this.
I'm going to take it from you just for a second because there's a story that's moving from Bloomberg. And if you see the movement in the market, this could be exactly why you're seeing the direction that we're seeing at the very moment, that the Treasury Secretary, Scott Bessent, this is according to Bloomberg, I'm reading directly from their report, has told a closed-door investor summit that the tariff standoff with China is unsustainable and that he expects the situation to de-escalate, that negotiations haven't yet started, but that a deal is possible. That is according to people who attended that session at an event hosted by JP Morgan in D.C. It wasn't open to the public. It wasn't open to the media. Those are the reports that are coming out. If that coincides with what you're seeing on the screen, then it would make some sense. We'll do our best, obviously, to get more out of that, to clarify it even further. But nonetheless, perhaps a little bit of optimism about de-escalating the situation with China would have a benefit on the market. I mean, that's one of the things you need.
Yeah, and by the way, we're hanging on every headline for that. And what that does is when you have sentiment, you have positioning so washed out, you're going to get moves like we're getting today. Right? And when we get a little overbought on the bounce and you kind of get some negativity, you're going to get the other. So I think we're caught in this highly volatile range for a bit until something comes along, brings us clarity, and breaks us out of this. And I think it'll happen. I really do think it'll happen. It's just a question of when.
I go back, Steph, to this JP Morgan trading desk, right? We need a completed trade deal. We need a resilient macro, and we need solid earnings. The problem is the macro looks ugly. Everybody knows that. Latest evidence, Chicago Fed survey of economic conditions was terrible. Both services and manufacturing worked into that report. So you can't say, well, one's good, they're both kind of ugly. Almost everybody at this point thinks that earnings estimates are too high. JP Morgan today says more downside. Strategists, most striking, they say, is the decline in the percentage of companies beating estimates. Just 68% of those that have reported so far have exceeded. That's the lowest rate in some time. And calls for a more significant slowdown are seemingly everywhere. The latest from David Solomon, Chairman and CEO of Goldman Sachs. Listen.
There's no question the trade policy that's been articulated, or the direction of travel, has changed the perspective on forward growth. So consensus on forward growth was 2%. It's obviously much lower now.
All right, so that's Solomon, but you get the picture, right? Everything that you need, completed deals, X, you don't have that. A resilient macro, X, you don't have that. And earnings just aren't that great, and they're not expected to be very much at all.
And that's why the S&P is down 10% on the year, and that's why the NASDAQ hit down 18% yesterday, right? Expectations are very, very low. Sentiment is very negative. Yeah, I'll give you some of the data that is really weak or weakening, but as long as the labor market stays strong, that's the thing that I'm watching. If that starts to fall in a big way, then Katie bar the door. Because that is the most important piece, because that's the most important piece for the consumer. And not only, but for the consumer, they need jobs, they have wage growth, inflation is certainly coming down. So there are some positives out there. In terms of earnings, only 25% of the companies in the S&P 500 have reported so far. It's way too early to call the game at this point in time. And I actually would say 68% beat rate is not so bad given what we're going through.
Not really.
And I will say, I will also say some things that we've learned today, and we're going to get to earnings later, but currency. the weak dollar is actually helping to offset some of the pressures and the commentary that we're hearing about tariffs and the tariff hit to earnings. So there are going to be a lot of puts and takes this earnings season. I think expectations are very, very low, so it's a low bar, but I think they will be better. I think margins are going to hang in. I mean, geez, look at 3M and GE today and their margin. So you have to just take each day by day. It is very volatile. It's very challenging. We've all been doing this for 30 plus years. This is probably the hardest year ever. But the sentiment is extremely negative, and it won't take much for this market to bounce like we're seeing this afternoon.
Jan Hatzius, by the way, follows up Solomon. And just before we came on the air today, Josh cuts his GDP forecast for this year to 0.5 for the obvious reasons: tariffs, tighter financial conditions, policy uncertainty. But what do you make of what you've heard already on the desk, and then what the street is making the focus of its commentary today?
Stephanie and I agree that sentiment is extremely washed out, and it's so washed out that these 800-point intraday Dow rallies are exactly what you should expect in that environment. The problem is the presence of washed out sentiment alone doesn't really give you a longer-term respite from the things that everyone is worried about. So we have these bear market rallies. They're fast, they're sharp, they're furious. You see people covering short positions. You see people, chasing after stocks because they think maybe they missed the bottom. They don't, historically at least, and maybe this time will be different, they don't often lead to a sustainable bottom while we're still talking about washed out sentiment. Like, it has to get to the point where we don't even bother talking about sentiment because it just becomes a given that everybody's bearish. I would love to tell you that I think we're there, but I just don't. As to what Rob was saying, I want to take his metaphor of waiting for Godot one step further. A lot of people are unaware of the provenance of that idea. Waiting for Godot is a play by Samuel Beckett, and it has no point. It's what they coined at the time, the term theater of the absurd. There is no resolution. It's two characters basically talking themselves in circles for 3 acts, and it never goes anywhere. Spoiler alert, Godot never shows up at the end of the play. And I think that that's what's starting to set in here, which is that we might get resolution with one country, but continue to battle with rhetoric another country. And this just might be like the permanent condition of the rest of the year. That's a worst case scenario. I'm not rooting for it. I certainly am not expecting it, but that's what's starting to set in here. It's like, oh, wait a minute. The negotiations are the point, not the resolution. So Godot might not come. As far as Jan Hatzius, I could have told you he was about to cut his estimate because he put out a piece of research on April 6th where he quantifies the effect of uncertainty on hiring, on business investment, on consumer spending. It's a really good report. You should try to get your hands on it. There are real numbers here. He's talking about a $25,000 to $30,000 per month drag on hiring every month for the rest of this year. He's talking about consumer spending, the wealth effect going from positive to negative, shifting that from a quarter-point boost to GDP last year to a quarter-point drag. These are really big numbers in dollar terms. He's talking about a 45% probability of a decline in CapEx this year. There are real impacts that transcend whether or not sentiment is washed out when you consider the gravity of what those numbers mean. And that's why I think this is not an environment where you want to go chasing bear market rallies.
Yeah, that's really what I think many people think this is, right? It's the bear market rally. You look at the S&P, like 2/3 of the S&P constituents are down well more than 20%. So, it walks like a duck, it talks like a duck, it's a duck, right?
Totally agree. I mean,
but what do I do? We've long said, when the market steps point is partly this, I think, market's already down a bunch. Unless I guess you think we are going into a recession, which I know you don't.
Well, no. The odds of a recession have definitely increased. I don't want to come across as some perma bull who's been taking, nitrous oxide here, Scott. You can't, Scott Bessent said it correctly. The trade situation with China is unsustainable, unequivocally so. Trade flows have basically gone to zero with tariffs where they are. Any company, and there's a lot of them, that rely on China for raw materials is going to run out of raw materials.
My point is it's because the market's down a bunch. Yep. It's hard for some to get all bared up now.
Right.
Because of a kind of headline that I read you, and the market was already up a lot, obviously, but it took another leg up. It doesn't take much. So people are afraid to get too negative now unless you have more conviction that you think a recession is more likely, because then you can easily make the argument that even at these levels, even with this pullback, that the market's still too high, that it's still overpriced, if you think we're going to have a recession.
I might even make the argument, not strongly, but I might make it, that you could get a short, shallow recession and with the trade issues at least partially resolved, go higher from here to year end. But I think there's a blend between what I'm saying and what Josh just said. Let me start by saying this is, in my opinion, all about the trade war. That's entirely it. And we see it in today's move higher on the Scott Bessent comments. To Josh's well-made points that the negotiations may well be what the whole point of this is, I think I agree, but I would also point out that the markets and the economy can adjust to that. Companies can adjust to a lower, albeit still high, but a lower level of uncertainty. I think they did that in the first Trump administration. When you look at how bad 2018 was, 2019 surged higher. But the sine qua non here is you have to get some resolution. Okay, well, that's fine, Josh. I'm going to continue on with what I'm saying here is that
not going to happen this time?
Yeah, it could. I mean, the Fed thinks it's restrictive. I don't think we're going to disagree on that. And the Fed funds futures market, whether it's right or wrong, does expect more cuts.
Hey, let me ask you this question since you're talking about that. What happens, just for argument's sake and for the sake of this conversation, what happens if the Fed cuts rates tomorrow?
I hate that idea.
No, I'm just saying.
I hate that idea.
So what happens if that happens?
The market goes down. I'll tell you what happens. The market initially goes up for about 10 minutes. For about 10 minutes it goes up. And then after that it says, what the heck does the Fed know that we don't know? The last thing you want right now is an emergency rate cut.
No, I don't mean like tomorrow in an emergency. I mean figuratively, if let's just say there was a meeting tomorrow and the Fed cut now. Yeah. They cut now. Is my point. Not like thinking,
I hear you.
You know what I'm saying?
So I think I said this last week, is that what we really want, or at least I want, is no surprises from the Fed. Right now, the Fed is expected to cut in the meeting after this. Okay, if they were to cut if it were a regular scheduled meeting tomorrow and they cut, what the market would say is it goes back to Powell's comments last week where he said, we're going to look, if both goals are in tension, we're going to look at how far we are from each of them and the path to restore them. And if they were to cut at the next meeting, that would be the Fed's way of saying we're worried about growth.
You're making it too complicated. If the Fed cuts, is that just unequivocally positive for the market? That's all I want to know.
That it would be negative because they shouldn't. They should not cut. When you look at the hard data, it's totally disconnected from the soft data, and it's going to stay disconnected from the soft data because of the pull forward in demand, everybody trying to beat the tariffs on spend. So you're going to have this hard data lag that is not going to permit the Fed to cut, period. So if they cut, it'd be idiotic, and I think that would be viewed as negative.
They don't need to be restrictive, though. They can be neutral. They don't need to be restrictive. And they think they are restrictive. And they are, actually. And by the way, we are making progress on inflation. It's not to their target, but I'm not saying they're going to go 100 basis points. 25 basis points would be an indication that they're not
watching
ignoring
the jobs number.
They're not.
They're watching jobs.
That's the only thing that they're
May
looking at. They're not looking at inflation and the progress on inflation. They're not looking at productivity, and that's actually been better than expected.
But what drives
which will
jobs,
lead to lower inflation.
What drives jobs?
Well,
hard data.
Look, I'm the one that has been a bull on the labor market.
I'm not following your day-to-day moves,
but my point is, inflation has come down substantially. Growth has come down substantially. We grew 3.4% in GDP last year. We're going to grow 1% this year.
And the mood's bad, so we cut.
If they were to cut 25 basis points, that's not 100. It's not emergency. It's them saying, you know what? We kind of see what's going on.
Okay,
will
so
they
you,
do it?
hold on.
Will they
so
do
you
it?
agree,
I don't think that they will do it.
So you agree,
That's why
you
I said,
agree with the president that they should do a preemptive cut, because that's what you're arguing for.
I don't know if it's a preemptive.
That's what you just made the argument for.
No, because I'm saying
you
that
just made that
inflation
case. You
has
just
come
didn't use the
down.
word.
Inflation has come down and growth has come down.
None
the only
of
thing
this-
that hasn't come down is the labor market.
Yeah, but you're arguing
dual
for
mandate.
a cut
I'm arguing
in case the labor market does worsen.
Not in
It's not going to
case,
matter.
Not in case.
If you
And not
don't-
labor. It's on inflation. They have a dual mandate. And labor has been strong. I've been saying that for months and years now. It's the inflation thing that went from 9% to something like 2.5%.
You're
That's
making the
progress.
argument, though, that you think the Fed should cut.
I think they should.
Okay.
Yes, I do.
It's not going to matter if ships aren't flowing between America and China.
Josh?
Unemployment is a lagging indicator. Respectfully, I agree with Stephanie here. That is not the metric that should determine the entirety of what the Fed is dealing with right now. The Fed is stayed at this moment not by the labor market, but by the concern of reigniting animal spirits at a time with high prices that are being caused artificially by trade wars. If I understand correctly the Fed's dilemma, I think that's where they are. Absent this tariff stuff, if we were just looking at the data itself, Rob is right, the data is strong, but it's probably not a 4.5% Fed funds rate economy. So absent like concerns about price spikes, this is not a 4.5% Fed funds rate environment. It just isn't. And what the Fed should be looking at is spreads blowing out, not last month's non-farm payrolls. And by the way, go back and look at 2007. The labor market was, the unemployment rate was under 5% the entire year. And meanwhile, the recession magically snuck up on everyone. When they went back and actually dated the start of the recession, it was December of 2007. I think it was pretty clear to all of us in August, in September, in October, there was absolutely no reason why the Fed's worried about inflation right now. Things are falling apart. So I don't think we need emergency rate cuts. Rob is right. The labor market data is strong. But Stephanie's right. There's a lot more happening beyond the labor market, and the uncertainty itself is what's going to undo that labor market strength the longer it persists. We should be getting easier. Now, Europe cut 7 times. I'm not saying Europe is the paragon of central banking, okay? They're flawed too. But I don't know why we're sitting on our hands here when all of the sentiment and all of the trends are going in the wrong direction.
I agree with that, but the question was what would happen immediately if there was a cut. And I don't think there's going to be some ripper rally.
I think it's implied that if the Fed cuts, it's automatically positive for stocks. I just want to know what you guys think. That's all. You suggest maybe for a second, but not in the bigger picture.
In the bigger picture, what really matters is the clarity on the tariffs and what ultimately happens. When do we look through to the other side of this? So we could have a scenario, a very easy scenario to see where we get the soft data, the hard data starting to roll over. You get the cuts at the right time. You have clarity on tariffs, and all of a sudden that was a speed bump, and we're looking through it. So we had this deceleration, and we're looking through it as transitional. That's a very possible outcome, which is why all of us stay invested the whole time, positive or negative.
If you look at stocks that would be moving, for example, on a Besant headline like the one we got, let's see an intraday of Tesla, which I think is at the highs of the day, because it's got all sorts of issues. The tariffs are certainly one of them. And the company reports earnings today after the bell. Stock's up 6%. I think it's just a good place to look to see an immediate reaction for an individual name that I can't remember, to be honest, guys, another company or stock with this much noise around it. You like this one: tariffs, brand damage, Doge, sales declines, price declines, gross margins. All of the things that have been talked about are going to come to a head tonight. Nobody owns this stock. I'm kind of surprised that maybe you wouldn't take a look at this in any sense.
Let me just say this. Is it because of my political leanings, or why do you say that?
No, I don't know. I just have a feeling like you've maybe kicked the tires, pardon the pun, on something like this, and it's down. It's down 50%, down 40% year to date.
I don't even know what PE it's trading at right now, but it's still expensive, and we color within the lines, and everything else we own is properly valued in the Mag 7, which is a lot of it, but we're underweight the Mag 7 relative to the to its constituent. Relative to the S&P, we're underweight the Mag 7,
Josh,
and we're underweight because of Tesla.
Josh, you remember, a stock, a company that has this much hair on it going into an earnings report like this one with a market cap the size of this one, at least what it was, still is large, but not as large as it was.
So historically, I have missed out on a huge run in Tesla because I never believed in it. I'm not in the cult, and I was wrong. What I would tell you now, this is a company where we're being told, the shareholder base is being told, ignore the fundamentals of the business and focus on robots. Like they're like flat out, don't worry about how many car deliveries last month. That's not relevant to the story. 90% of Tesla's revenue comes from auto. And we're being told the cyber taxi is going to be such a monumental growth driver and completely transform the transportation grid of the United States and elsewhere, that is the reason to bet on the stock in the intermediate term. And then in the long term, everyone's going to have a Tesla robot in their place of work or in their home or both. And that's the reason to buy the stock. And those things might actually be true. I mean, the CEO is one of the most innovative human beings who's ever lived. But that's not the type of investment that I typically make. So, like, if I'm being told, oh, yeah, 90% of the business is cars, but don't worry about that. That's not what's exciting. Be excited for autonomous taxi, be excited for robots. All right, I guess, but probably not with a stock that's 50% off its high and falling. So it's not for me, but there might be an opportunity here if people get too negative, or if the auto sales picture from Europe and Asia is not as dire as the street thinks it is. The stock could probably bounce 20, 30 points. I wouldn't tell you it can't.
Throw up Apple too, guys, if you wouldn't mind, intraday too. I feel like that looks to me like it highs of the day also, just because of the China relevance that it has in all of this, and maybe just the optimism that's trying to be reflected in names like that. Back at $200. And a really interesting report today from Eric Woodring. He's the top analyst over at Morgan Stanley who covers that stock. Has some positive survey data out today about upgrade cycle, which surprised many people. He reiterates his overweight today because of that. $220 is the price target. Then you have the Wall Street Journal today talking about Buffett and timing his Apple sales just perfectly. Arguably, they say one of the most lucrative single stock investments of all time. They made a paper gain of $110 billion when they began selling it. I'll just give you a quick comment on that because you own Apple and you own Berkshire.
Yeah,
right?
Yeah. Well, and I just remember, Scott, as you do, I was very small in Apple until about 2 weeks ago when the deluge happened, and then I picked up a meaningful amount of it. And what you didn't add to that list is the sentiment around this stock, which is to say retail investors love this stock. And I, Josh, Stephanie, Rob probably see this as well, that when you go and you trim Apple from a client's portfolio because you think it's too big, almost invariably you get a call from the client saying, why did you do that? Don't ever do that again. And this may sound like something ephemeral, but it actually matters. There is a strong amount of sentiment. It may not be as big as, say, Tesla, and Josh was just discussing that a minute ago, but it is vibrant. And if you add to that some fundamental drivers like you were just talking about, Scott, I think it's easy for the stock to go 10, 15, 20% higher from here.
All right, let's take a quick break. We come back. Stephanie Link mentioned 3M, albeit briefly, best performing stock in the Dow today. And we have ownership in multiple places here on the desk, so we'll trade that. FTC's taking aim at Uber. Obviously got to get Josh's take there as well. And later, we have a halftime exclusive interview coming up with the Disney chairman, James Gorman. Excited about that one. We're back in 2.
CNBC. Live ambitiously.
Today's Most Active Stocks Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies.
All right, welcome back. I want to call your attention to CNBC's newest subscription streaming product, CNBC Plus. You can stream Halftime Report and all of your favorite CNBC shows anytime, anywhere, and also on demand. You can see the data feed on your screen here, and we hope you do that. And I think you'll benefit from it. Let's get to 3M now, because it's a big mover today. It is the best performing stock in the Dow. Rob, you own it. Stephanie Link owns it. You love it. You bought this for a turnaround.
Bought it in March when they announced that Bill Brown would start at the company. He didn't start until May. It started working as it should, because the company is really focused on changing everything at the company, and he's doing a really good job. So they beat on revenues. Organic growth was very mixed. Electronics were good. Autos not so much. Kind of expected, but it was the operating margin story that was so exciting. Up 170 basis points, better than expected. Up 220 basis points year over year. I think they're in the second or third inning in terms of margin expansion. They also, by the way, increased their buyback. And they did talk about currency helping them to offset tariffs. Tariffs are going to hurt them 20 to 40 cents. So now we know, at least we can model it, but you have the weak dollar that's also helping. So I think the story is really exciting. It remains one of my largest industrials.
All right. Wanted to get, Josh, your take on the FTC suing Uber, alleging that they charged for Uber One without consent. What's your take on this name right here?
It's not true. I'm a member. I could cancel right now if I want to. So I think look, they want big headlines. They want to score wins, and I understand it. And if what they were alleging was true and then the product changed, that's possible. But I don't think that the marketing practices here were deceptive, my opinion, and I don't think it's hard to cancel. So I'm not 100% sure where this goes or how it ends or if it's a settlement, but I think Uber looks like they're going to stand their ground and they think they have a winning case. This is just like when you own large cap tech, this comes with the territory. There's litigation, there's lawsuits, there's regulatory actions. You just have to prepare for that mentally and not react to every headline.
Okay. Let's talk United Health. Steph, you first.
Sure.
Just because the stock's just gotten hammered.
Yep.
In a really short period of time. It surprised a lot of people. Downgraded today at HSBC. That's a new 52-week low for UNH. You trimmed it a while ago, but still, what do you do now?
Well, so I bought it in February when the DOJ coding issues were out there and the stock had fallen so substantially. It rallied 16% off those lows. That's why I trimmed a little bit. I didn't trim it all. I should have probably in retrospect. But actually, this was the first miss that this company has had in a decade. That's to speak to its consistency, strong execution, strong management team. They're going to find a way to fix this. It's going to take time. A lot of it has to do with Medicare Advantage and utilization rates going up. That's because they priced this stuff so high, and so people wanted to get their money's worth. That's good for the consumer, for sure, not good for the company that has to pay for that. So this is still the number one managed care company in the industry with a very strong balance sheet, with $10 billion in buybacks to come. I think the medical loss ratio, the margin story, is at its worst at this point in time, and that's what they guided to. So I think from here, I think you can see an improvement in the medical loss ratio, margins, and the story. It's going to take time, though.
Why no love for McDonald's on this desk? Rob, Jim? It was reiterated a top idea today at Wells. We can take a look at the stock. That's why I wanted to look at it today. 350 is the price target. They say trends are digested, shares are defensive, FX now is a plus, and sentiment starting to improve. It's up 7% year to date in what's been a really tough tape. Why no takers?
I'm not gonna hate on it.
It's on my best stocks list.
And so I'll make this quick so Josh can come in. Look, it's more of a defensive name as far as I'm concerned. At this point in the market, and this goes back to what Steph was saying at the very beginning, at these levels, I want to be more aggressive with the things I own. But I don't have any hate for this stock. It's just defensive. It's
you
not
want
what
to be more
right
aggressive in what's been a very defensive market?
Yeah, again, and I'm gonna quote Steph. She had the numbers. I think we're down 15% from the high of just 2 months ago, down 12% year to date. Yes, this is the time I want to be more aggressive. I don't think, and I understand people disagree with me, but I don't think this is the time to hunker down.
Josh?
On February 25th, my birthday, I told you McDonald's got added to my best stocks in the market list. It's acted extraordinarily well since then. Another very similar name that's already broken out is Coca-Cola. This is a new all-time record high price. The Wall Street Journal is talking about maybe Berkshire taking the whole thing private and buying the rest of it that they don't own. McDonald's is a similar category. I think when people talk about the end of American exceptionalism, they should pull up some stock charts, because McDonald's is like one of America's greatest exports to the rest of the world in terms of financial success, at least over the last 50 years. And this stock is about to break out. So it's been a strong stock all year. It is on my best stocks list. I'm not in it. I should have taken the trade. I didn't. Hopefully some other people that were watching the show that day did.
All right, we hope. Let's get the news now with Silvana Henao. Hi, Silvana.
You on Fox News, Hegseth doubled down on his argument, saying that the information was informal and not classified. Earlier this week, sources told NBC News Hegseth had sent information ahead of the strikes in Yemen to a chat group that included his wife and brother. The EPA has started to lay off its environmental justice staffers. It affects about 280 workers, and the agency said their work no longer aligns with the EPA's mission. According to the memo obtained by NBC News, the reduction in force will take effect on July 31st. The agency previously announced major rollbacks of environmental regulation, probationary worker cuts, and put other workers on administrative leave. And the Washington Post is joining forces with OpenAI. The Post said today, as part of the deal, it will be able to make summaries, quotes, and links to its stories with ChatGPT. It is the latest major news organization to sign a deal with the AI giant, following News Corp and Condé Nast. Send it back to you.
All right, Silvana, thank you very much for that. Silvana Henao. Up next, that halftime exclusive we told you about. Our Leslie Picker standing by with the Disney chairman, the former Morgan Stanley chairman and CEO, James Gorman. We get his take on everything going on right now next.
Nina?
Mom?
Nina, wait!
You've got to see this. Come on, what are we waiting for?
One of 5 immersive worlds in Epic Universe, only at Universal Orlando Resort.
One thing I've learned over the years is don't yell at the stock market. Why do we follow the markets? It's to make money, and because it gives us a lens on how the world works. Ambition is the ability to see yourself in the future and to take steps right now in the present to become that future person. CNBC viewers are very ambitious. At CNBC, we are in the dreams business. You're watching to learn something.
It's a new science that could disrupt the medical industry.
The project is to understand the genetic makeup of Asians and to find out which of those genetic markers are ethical markers and not disease markers.
We're taking the bone marrow cells from the patient, making the edit, and we're putting it back into the patient, making a drug just for you.
I think that this technology is going to totally reshape how people have children.
The Edge dives into the world of genomics.
All right, we are back. We'll send it to our Leslie Picker now at the General Atlantic Investor Summit with a CNBC exclusive interview. Leslie, take it away.
Scott, thank you so much. I'm here with James Gorman, who is a recently added advisor to General Atlantic, the growth equity firm, and of course, chair of Disney as well. Thank you so much for taking the time today. Really appreciate it.
Sure, great to be here, Leslie. Great to be back with you. Been a long time.
Likewise, it sure has. And we have so much to catch up on because a lot has changed since we have heard your perspective. First of all, the market is jumping today because of some headlines from Bloomberg about Secretary Bessent discussing the situation with China being unsustainable as it pertains to this trade war. Do you agree with that? And do you think that the way things are going are unsustainable as it pertains to the economy?
Well, I think that, the tariff trade wars, if you will, have clearly been a shock. I mean, it's reflected in the U.S. dollar, it's reflected in rates in the bond market, and it's reflected in the equities market. So I think the job of the Treasury Secretary, if you will, an additional title would be Chief Marketing Officer for USA. And I didn't see his comments this morning. I don't know if they're in a public forum or not, but I think bringing some sense to investors, what is the end game plan here? Where are we actually heading with this, and what do we expect the outcome to be? Because clearly tariffs have an inflationary aspect to it, and that's going to affect how the Fed behaves going forward.
In the meantime, in your role as chair of Disney, a large multinational company, as well as General Atlantic, you see all the portfolio companies and kind of how they're weathering all of this uncertainty. Do you foresee a recession here, some sort of growth slowdown? What do you think the overall impact of this tariff uncertainty will be kind of on these multinational companies and entities?
It's really hard to predict. I heard this morning that two of my former peers, bank CEOs, one projected treasuries will be around 6% a year from now, the other 3.5%. It's too unpredictable, I think, and that's what you look at the VIX. That's why the VIX is where it is. We're in a world of a lot of unknowns, so predicting whether we end up in a recession or not, it's too early to say that, but certain things are true. One is tariffs are generally inflationary. Two is the Fed is reluctant to cut rates in times of inflation when they have a dual mandate of employment and inflation to control. And three is it's very difficult to know the impact on global trade and what that does to the global economy during this very dramatic shift in tariffs. It's certainly more likely recessionary bent than not, but it's too early to say.
More recessionary than not, and that range that you gave of the interest rates was notable as well. Speaking of rates, one area that's kind of caused some volatility lately is this concern that the Fed's independence could be in question, that its credibility could be in question. Is that something that you're concerned about?
This isn't the first time an administration in this country has disagreed with the Fed. The Fed's job, its dual mandate, as I said before, is unemployment and inflation. It's not to manage the economy. They remain independent, and the role of the Fed chair is an independent role, and I expect that will continue. There'll always be, not in every administration, not in every time, but certainly in times of high economic volatility and uncertainty, there will be different points of view. But the Fed has proven itself to be very patient, absent clear evidence of what to do.
As chair of Disney, succession has been in the spotlight here, and you were brought on because of your experience with succession at Morgan Stanley, which is largely seen as a pretty painless, bloodless succession, which can be pretty rare on Wall Street, and Morgan Stanley in particular. How is that succession search going, and do you think that you'll be able to meet or even exceed the timeline in the sense of pulling it forward, the timeline for finding a new CEO?
Well, given you raised Morgan Stanley first, I'll just say how thrilled I am at the job Ted Picker's doing, working with his great presidents, Dan Simkowitz and Andy Saperstein. They had an extraordinary first quarter, and the company's in great shape, which is one of the reasons I can go off and do the other things I want to do. For Disney, I can't really talk about the succession. We've said publicly we'll have an answer by early 2026. That will happen. The exact date is obviously for the board to figure out, working with Bob Iger. But we have a clear process. I think we're in good shape in that process. And, we've laid out a plan, and we'll stick to the plan. It's not very complicated.
I was just actually, ironically, at Disney Parks yesterday. It was extremely crowded, lots of people. Do you see any effects from kind of the geopolitical situation playing out on consumer spending and people's appetites for travel, particularly as it pertains to maybe some international tourists? Something I anecdotally didn't hear much of was foreign languages at the parks.
Well, first I was there 2 weeks ago. You're in Orlando?
Yes.
What was your favorite ride?
My favorite was Guardians of the Galaxy. It was a new one and really enjoyed that.
And your favorite park?
Epcot.
Okay.
Epcot was my favorite.
I loved them all, but I loved Animal Kingdom and I loved the Avatar ride. But I think, listen, Disney parks are, I think, about 40% of the company now in revenues. They're very global. There are several parks outside the U.S. in Greater China, in Japan, in Paris. So it's a very global company, and maybe it's too early to say. Maybe the flow of people visiting parks changes as to which parks they go to. I obviously can't talk about the present environment because Disney's going to announce its earnings in a couple of weeks. But I've been a fan and involved with and consuming Disney product for almost all of my life, going back to when I was a kid in Melbourne, Australia, and that will endure whatever this economic cycle is.
The diversification of its footprint, absolutely. James Gorman, thank you so much for taking the time today to speak with us.
Thanks for having us.
Really
Great
good to catch up with you and get your perspective.
Thank you.
Scott, I'll send it back to you.
All right, Leslie, thanks so much for that. Leslie Picker. Coming up, we get the committee's take on the defense space today. Those stocks are certainly worth trading. They are down in a very big tape. Back after this.
CNBC. Live ambitiously.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
My earliest ambition was to be a teacher, but I felt I couldn't afford it. My mother thought it was the highest calling, and I gave her a promise that one day I would be a teacher if I did well enough in life. It was my ambition, and I was able to achieve it. So now I can teach you so that you can be as ambitious as you want about whatever you want to do. CNBC is my home. If you love your work, well, maybe it's life itself.
Kelly Evans, The Exchange, CNBC.
Staying long, 3M.
AbbVie. Salesforce.
Intuitive Surgical.
All right. See you on closing bell. The exchange is down.
Thank you very much, Scott. We'll see you then. Stocks are surging this hour on hopes for a de-escalation on our many trade fights. A source familiar telling CNBC Treasury Secretary Bessent sees de-escalation with China ahead. Welcome to The Exchange. I'm Kelly Evans, and here's what's ahead. The dollar index is down 9% so far this year. It's the worst start to a year ever, and easily the worst start to a new presidential term. Trump has made it clear he wants Powell to cut rates, and our guests actually agree. Two of them see more cuts than the market this year, and for different reasons. They are here to make their case. Plus, the weaker dollar and the tariff threats have only strengthened the bull case for this name, according to our analyst. His contrarian take on a few opportunities in retail right now and the names to avoid. That's our mystery chart today. Before we get to all that, though, let's get right over to Dom Chu with more on this market rebound, Dom.
That's right. That market rally bull is taking the place of that market
giant bear kind of bear that we saw yesterday, and there's a good reason why, because at these levels, the markets have pretty much gotten back every single point that they lost during yesterday's sell-off, and we're hovering towards the session highs right now. The Dow Industrials at 39,180 are up north of 1,000 points. It's a 2.5% gain there. Same percentage move for the broader S&P 500 at 52.93. It's up 135 points. At the highs of the session, we were up 151, and even at the lows of the session, trying to bounce today, up roughly 49 points. That is your intraday trading range. Again, tilting towards the higher end of that. The NASDAQ Composite up a full 3%. Or 483 points to a level of 16,358 for the NASDAQ Composite Index. A couple other places to watch right now. We are seeing another day, another record high for gold prices, though with those Besant comments that Kelly just mentioned, a little bit of that risk or safety trade has now come off, so gold prices are off their record highs. I will still put a star up here because they did hit one earlier, but 35.0990 is your new high watermark on an intraday basis.